This is the headline that's garnering all the attention today.
All the evidence shows there's a investment boom going on.
Markets are looking for clues about the health of the job market.
Artificial intelligence absolutely has already been a disrupting force.
People are right to question how much longer this bull market can run.
With stocks rising, fueled by big tech and easing trade tensions.
This week, the Fed voted to lower interest rates another quarter of a point.
Take a look at futures. Now a little bit of a mixed bag. We've actually seen the Dow tick lower.
Oh boy, here we go again.
It's time to tune out the noise and tune into great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that will move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. It's August 10th, 2026. I'm Aaron Kolkman. That's Lucian Gindorf, and this is A Steward's View. This is a program dedicated to integrating knowledge and wisdom to enhance your decisions as stewards, with or without advisory professionals. Today, on this ASV, this is an ASV Plus episode, which means we're catering to a more advanced investor or an institutional accredited type investor. And this is a series called Peace About Portfolios. So we'll focus on, one more time, retirement income planning. This is kind of a revisit of last week's episode that was also more advanced. And what we want to do is combine a series of conversations we've had over the past year and a half as this program's got going and developed kind of a following and its own life. And so we've got some momentum here on all the major channels with Spotify and Amazon and Apple and YouTube. We'll talk about social media later, but there's a lot here. I want to make sure we talk to those of you that did catch some of last week, in addition to those that didn't. But last week we were all about retirement income planning as well. And so we'll continue that. We'll combine asset optimization concepts, total return investment points, and we'll arrive at a consistent method of taking withdrawals from your portfolio. Then we'll really just work to keep the portfolio in its place, which is in support of your plans. So I've done this work, Lucian, for about 25 years, and I've gone through a series of credentialing steps. I'm a Master's of Science in Finance and Economics, a certified financial planner, and so those are the major things. I joke that I studied too long, but I've spent a lot of my time working in from a career standpoint on asset optimization in support of financial plans. And my hope is that in these kind of episodes that we bring as much of that fruit to bear as possible, and we direct the listener, to resources that you can use to benefit yourselves, and if you're an advisor type, to your clients as well. So before we get going, let me direct you to our weekly blog. That's live by midnight every Monday. That's out at A Steward's View. That's astewardsview.com/blog. You can find context from scripture there that we've had every week now since we started, as well as the weekly roundup. And that's a summary of what's happening with the economic picture in various markets activities. So find us there at astewardsview.com/blog. So with that context in mind, let's take a look at what's in store for you today. I promised last week that we would delve into a non-optimal portfolio as it relates to retirement income planning. What do I mean by non-optimal? What I mean is a portfolio that hasn't really been honed in on from the standpoint of the interaction of the holdings together, right? There's a lot of excitement around a stock. There's a lot of excitement around a fund or an ETF, the flavor of the month. Okay, short-term, long-term, whatever. Long-term listeners know this is a long-term oriented program. But when we talk about asset optimization, what is and what is not optimal, we're first talking about, how are the holdings that we're ultimately going to have working together, right? So when we say, okay, it's a non-optimized portfolio, we haven't had that conversation yet, right? The investor hasn't really looked at that, or the advisor hasn't brought that up. Okay. So that's what we'll do today. We'll look at a non-optimized portfolio, one that has some very good holdings, that's actually performed relatively well, but just isn't delivering the same kind of consistency that it could, historically speaking, has not. I'll say it that way. Past tense has not generated the consistency that it could as compared to an optimized example. Okay, now by optimized, I don't mean perfect. I don't mean this is the best portfolio ever, you should buy it. What I mean is we have looked at the holdings together, how they interact with each other, and how they deliver consistency, right? We've made a determination. If you go way back in 2025, there's an episode called 1 + 1 = 3, that something greater is happening, that we have a return premium due to the allocation, right? And there's a calculator for that. Okay, and for you professionals, I'll call it the MVA calculator. And for you investors, I'll call it the MVA calculator. Okay, for the professional type, it's mean variance analysis. For the investor, it's measuring the value of advice. So I encourage you to use that calculator. It's out at fidereadvice.com. Fidere is spelled Fidere, advice.com. And you can visit that calculator in the footer of the website. I think we have them have it renamed now to Advice Measurement Calculator or something like that. But use that freely. You don't have to accept cookies because we don't track your activity. Just please use that. Take the metrics required to calculate yes or no, and if yes, how high, as to the return premium or the excess return due to the allocation that you currently have. Okay, and then find out how that relates to the market. Find out how that relates to something more optimal. And if you hear this one example today, we're actually going to use a different example than last week because I didn't get the comparison data I needed to provide to listeners. But we will go back a little bit further to the prior to last week. We had one other recent ASV Plus where I talked about a retiring couple in their 50s, and we'll use that example because I do have comparison data for that readily available. So we'll go there. But I want to emphasize that MVA because it's the cornerstone of how we know whether or not we've got something that is better due to the allocation. And that matters from a consistency standpoint, particularly where we're looking at risk-adjusted returns. Okay, and I don't want to go all the way into that, but last week we made the comment, optimization has to do with aggregation first, and then it has to do with where in the world are we going to invest, who in the world are we going to invest with, and how in the world are we going to do it. So MVA takes that process and it deals with the aggregate, the overall portfolio, and it answers those questions and gives you an answer, yes or no, and if yes, how high did I get a return premium due to the allocation, MVA. So I encourage that highly. FidereAdvice.com. Fidere sponsors this program, and I've operated that firm as a state-registered firm, for the last 6 years. So I think it's valuable to you. It's free, and your advisors can lean into that as well. So for today, let's look at this case study. I pulled up what kind of a midpoint income amount that an investor could take. Last week's episode dealt with a really high withdrawal rate, right? So when I say income, I mean withdrawal from the portfolio, income to the investor as a fixed withdrawal rate. And we talked about that high withdrawal rate. The need was a couple of years at 9%, but we ran out 9% for over 5 years last week. And then we ran about half of that at 4.5. So this week I'm running a 7% withdrawal rate with and without optimization steps completed. Okay, and if you want those optimization steps, they are in both of our recent ASV Plus episodes. So you can go take a look at those out at astewardsview.com. But here we go. I promised we'd look at the non-optimal example, all right, as we closed last week. And so here it is. This is not the same exact case study, but again, it's a case study that's also recent and one that we had comparison data for. An excellent set of holdings. This will be posted tonight, by the way, and you can look at this. There were 25 holdings in this investor's portfolio, totaling a little over $2 million. We accounted for all fees and net of fees. The investor, during a 5-year time period, ending July 31st, 2026, netted 8.13%. That was just the return. All right. I'll try to pull out risk data here if it's readily available, but I want to point to the behavior of this income plan very quickly. $2.2 million went in. This is over the 5 years. So at the beginning of the 5 years, which would have been, in this example, July 31 or August 1st of 2021. So there's a bear market in here in 2022. That's important to say. That's valuable. Why? Because we get a sense of different market contexts as we go through this. And I mean a bear market for stocks. Okay. So we had August 1, basically, of 2021 through July 31st of this year. The average return net of all fees, 8.13. Okay. So the 2.2 goes in. $817,000 comes out. And that's a 7% withdrawal rate increased at 3% per year for inflation as to the original withdrawal dollar amount. Okay. And I won't belabor that math, but I will say we started at $154,000 out rounded, and then raised it a little bit every year. Okay. Like, prorated among the 25 holdings that this investor originally had when they came to work with our group at Fideer Advisors. Okay. So over the 5 years, 2.2 goes in, 817,600 comes out, and I'm rounding. The end market value, because we had returns of 8.13 and withdrawals of 7, the end market value, probably not a surprise, 2.24, almost $2,225,000 rounded, right? So 2.225. Okay. Started with 2.2. Not a bad outcome. I mean, I look at the closest fit global benchmark, or really a series of benchmarks pulled together, and it was a beat on return on the benchmark. Straight withdrawals occurred at 7%. The original capital stayed intact. We adjusted the withdrawal amount or the income amount for inflation. We did not see the portfolio keep up, though. We saw it keep up nominally. Okay, so yay. But we started basically where we were we ended where we were when we started. That is to say, the nominal amount is about the same at 2.2 million. There isn't any extra there for inflation as to the asset base. In other words, the value of that $2.2 million, the power of it decreased over the 5 years, and we still just ended up with the same 2.2. So ideally, we do more than just cover the withdrawals in situations like this. Yay to inflating the income, but we also want to take and see that asset base itself keep up with inflation as well. And that, I'd love to say inflation was so low during the last 5 years. It wasn't. Sticky means relatively high. It's been more like 4%. We would have needed closer to $2.5 million in this example at the end to say, yep, we kept up both in terms of income and the asset base with inflation, but not a bad result. Very encouraging. Happy to see that. And there's a correlation matrix in there as well. I'm going to try to pull out the risk scores, as I mentioned. I don't know how quick and easy that will be. Okay, I've got a 5-year. That's the focus in my practice anyway. Yeah, the portfolio had a risk profile overall, or standard deviation, 14.5. The marketplace was 12.72. So higher on risk than the marketplace. And there was some excess return with the 8.13. I said that was higher than the market as well. The market was 6.34 per year in return during that period. So, sum total of those comments, those metrics, the Sharpe ratio was higher for this investor without any optimization work. They did cover, nominally speaking, not with inflation. They covered all of their withdrawals, and they got to inflate their withdrawals a little bit. So this was a pretty good outcome. Wouldn't you say, Lucian? I mean, if somebody said, hey, I've got, this program you can, set up, and historically this is how it's gone, and you've got, $2 million in, and 5 years later, perhaps $2 million out, and you took withdrawals at 7%, $150,000 a year, right? I'm rounding, and you can inflate that a bit during the 5 years. Okay. Like, I don't think you'd give that a thumbs down, would you? Okay. So me either. And that's why optimization is so huge. I have meeting after meeting after meeting with good investors and sometimes advisors that quite honestly, they look at me sideways when I talk about this, because that's a convincing result. And I'm not downplaying this result. I'm just saying, but what did you miss? And how would you know? So find out. Go to fideradvice.com, go to someplace else, sign up for Fusion, aggregate assets, get an ongoing second opinion, get quarterly reports like this, and put that data into this calculator I just mentioned, and don't sign a contract. It costs you nothing. What's my end game? Well, I have a full practice already. I want my industry to be better. That's why I'm doing this. I don't volunteer my 12 hours every Monday to hear myself talk. I enjoy it, but there's a cause here. So take a look at this optimized example. Maybe that'll help drive home the point. So 24 holdings instead of 25. We looked at where in the world we want to invest. We looked at who to invest with. We looked at how the holdings themselves, once we're invested, have worked together. And by the way, everything in both cases is quarterly rebalance, because that's where the market's kind of had things the past 2 to 3 years anyway. So I use quarterly rebalancing as an example. But same time period. Here we go. $2.2 million goes in. $150,000 comes out. It's rounded at 154. Inflated, the same $817,000 over 5 years comes out. Okay. Well, last time we covered our withdrawals in a nominal sense, we landed with a little bit more than we started with, or this investor did. And if you remember that number, Lucian, it was 2.225, right? That they landed at. Here they're landing. Let me give you the net after all fees return in this example. And these are hypothetical examples. This is, it's not pie in the sky in the sense that these are management teams that are really being used by this firm. It's not pie in the sky in the case that this is a possible withdrawal rate for this client to do from these exact holdings. It is pie in the sky in the sense that we haven't had, right, and that's maybe not a great phrase, but it isn't actual because the transactions haven't been done at certain times, or tracked when they've been done at certain times, to say, okay, these are composites, right? I've recently said that my firm started to run composites this April. I'm really glad for that. But this is very, very realistic in the sense that you can get invested in an optimized way or a more optimal way. And I'm defining optimization as, where, who, and how, focused on covariance or correlation, focused on risk-adjusted return per manager compared to their respective asset class, however many asset classes we're in, and that's measured by a 5-year Sharpe ratio with a lower standard deviation. Okay, so that's how I've defined optimization. So we got to be clear about what we mean. But I digress on purpose. The net after all fees result here from the optimization process being applied was 9.94. Okay, we're going to come back to the risk score again. We remember the non-optimized example had a risk score that was slightly higher than the marketplace. And again, all this will be posted at stewardsview.com/blog tonight. 9.94 after fees during the same 5-year period, landing at $2,452,000. So about $220,000 higher. $220,000. About an extra 10% or 2% a year on that initial asset base. Well, we just said that the previous approach was fine. It wasn't glaring. It wasn't, there was no problem. They didn't go into the bear market in 2022 and say, oh, well, what if I didn't go down as much, right? Nobody gets into the bear market and goes, oh man, let me just track my downside compared to the downside of the S&P 500. You just see it's down and you go, oh man, when is it going to be over? Right? At least nobody that I've talked to, right? I do that, but maybe that's part of the reason I get hired. I'm just saying the idea that we would know how much downside we don't have while it's going on, or don't expect to have, is the way to say that. Very, very hard to have that work particularly in a down market. But 2022 is in here. The downside here, by the way, I didn't mention in the last iteration, that was down about 18% for 2022. This is down 12.5%. That's the difference. Because when we're down $50 cents, we need $1 to come back. When we're down 40 cents, we need 80 cents to come back. When we're to even, right? And so on and so on and so on. So the less we drop in value during those hard times or those lower asset price times, the better from a consistency standpoint. That's the word. But also just from an asset retention standpoint. So that's a big part of how we get this asset base to move better without doing a lot different than the original non-optimized example, or the example without optimization applied. So there was 25 holdings. Here's 24. There we covered the 2.2 million, plus withdrawals. Here we did that plus inflation. Okay, well, let's make sure, if at all possible, that you listening can measure what you might be missing in terms of risk-adjusted return. And let me give you the risk scores here while I'm thinking about it. And I want to say a word about fees as well. Looking for the historical risk score. The historical risk score here, the 5-year 11.1. 11.12. The previous one was 14.5. So we've dialed down risk substantially. Return landed again at 9.94 after fees. This is backward looking. Also hypothetical, not actual, not composite. Versus the market at 6.34. So even just from a return standpoint, it's that same conversation. You don't close a good 5-year period and go, oh man, if we only could have got 2% a year. Well, maybe you do. But I'll ask the question, how would you know? So I want this to stay out front in our conversations when we talk about the value of optimization, right? The value of a second opinion. You don't have to get it from me, but get it from somewhere. And find out how you score from a Sharpe ratio standpoint, 5 years back, 3 years back, whatever you can get. Find out how you score from the value of advice in that standpoint, mean variance analysis. And that's, that's the core of this conversation. So don't miss that 1 or 2% a year. Don't miss the 0.5% a year on a large amount of money. So I just encourage you that way. It is a lot of work, but find a reputable place to go to get a second view, and do that. And then, think about it. Like, what platform am I on? I talked a lot about advisors recently, and where did they come from? What platform are you on? Is there a custodian that you're with that you like? Okay, great. Well, a custodian is just just a holding bin. I'm a fan of the good people at Schwab and the work that they do as our operations agent, but I'm not beholden to them. Right? They're do they do wealth management? Yes. And I would argue that's for people that don't know anybody else that does it well. So, find somebody that you can look to as a true expert, not somebody sitting in a call center, somebody that has a walk-in, sit down, go through detailed, good platform for you to sit on. And yes, a reputable custodian, operating agent, trading platform. Yes. But what's the advice platform? I haven't brought that up recently. My firm uses Advise-On. We made that transition from Morningstar Office last March 31st, I guess, April 1 this year. Great decision. Much more like a healthcare portal when you get logged in and you can kind of see the big picture and access all your plans and your documents and that. But whatever platform you're on, just understand, maybe it shouldn't just be your 401k. Maybe it shouldn't just be Schwab or Fidelity or some big name that you recognize, kind of like, name big, bad, and available, right? Like maybe you should actually look for real advice. And so I want to encourage you that way, the same as I've encouraged you in terms of relationship with advisors, right? Did you meet them and just at the golf club and you like them? Or do they have a background, a process, a credentialing, and some experience with what they're doing to deliver value to you one way or another? And by the way, have you measured the advice you've gotten from them or anybody else? So I want to give you those thoughts to go with as well, because platform does matter as much as the advisory relationship. And those two tend to go together, right? I would discourage you in general from just settling for the 401k or, just your trading platform where your assets are held to be your advisor, right? The same as I'd discourage you from having Bloomberg.com be your advisor or the Fed be your advisor, right? Find somebody that knows you, that knows what to do with this stuff, that knows how to help support you in funding your goals and doing it consistently. And, as I'm saying, let's measure that too. So when we get to it next week, we'll talk a little bit more about financial planning. I want to make sure we come back to the dynamic puzzle box. So I'm looking forward to that. I haven't really kind of closed out this episode yet, but I'll just say this. We've got a great resource at stewardsview.com for you. Costs absolutely nothing. The life cycle book is coming back here by Labor Day weekend or thereabout. And you can also reach out to us through the website or by email. Our email address is team@stewardsview.com. Again, stewardsview.com, team@stewardsview.com. Our social media pages are also on the website. So there's been a lot here. I hope this has been beneficial. I've really enjoyed this. I love this session. I hope you share it with others and let them chew on this for a while as well and hopefully benefit. From all of us here at ASV, we look forward to what's ahead. Again, next week, we'll talk about the dynamic puzzle box. What do you own? What do you owe? What's coming in and what's going out? So that idea that we're not just going to look at, well, how much debt do I have? How many expenses do I have? How much income do I have? How many assets do I have? We're going to look at all of it together. And we're going to make decisions from that. So I want to kind of tease everything that way because there's a lot of myths built into talking about one of those four corners instead of all of them. So we'll go that way. Until then, let's do connect out at stewardsview.com. Thanks for joining. Please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidare Advisors or speak with Aaron, visit fidareadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidare Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions, and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.